There's the closing bell on Wall Street, and now it is market domination overtime. Jared Blickery going to be along to get us up to speed on the action from this session. I'm going to start with the major averages and where they ended the day. We did see them come way up off the lows of the session where they were this morning. At the moment, we are seeing a mixed close here. The Dow and the S&P clawing all the way back to positive for the day, so finishing lower only for the NASDAQ here. The S&P up about 0.1%, and the Dow up about 0.4%. Let's get to Jared for a closer look at today's sector action.
Well, thank you, Julie. Let's take a look at the Dow and the Wi-Fi Interactive. Indeed, we climbed into the close, into the green on the close, but let's check out what we did for the month, and a surprising comeback, because at the lows, it was looking pretty dire, not necessarily in the Dow, but in the NASDAQ especially, down quite a bit. Here's the Dow finishing the month of April down 3.81%. Here's the NASDAQ. It's positive, 0.85%. Who would have thought that at the lows near 15,000? And then the S&P 500 down just slightly, under 1%, about 0.75% down. And we'll also check in on the small caps. The Russell 2000 down about 2.5%. And let's get to some sector action and check out what happened today. First, here we have healthcare leading, up about 0.8%, followed by industrials and staples, materials, real estate drops off from there. Energy, the worst sector of the month, is also the worst sector of the day. That was down almost 3 percentage points. XLY is consumer discretionary. That was down 1%. Utilities and communication services round out the negative performers today. But in the month of April, tech managed to come back very strong, up 1.6%. Staples also in the green, industrials and utilities following them to the downside. I mentioned energy, the worst off, down 13.9%, almost 14% for the month, but nothing is close to as bad as that from there. Healthcare, the next worth, not even down 4%, then materials, then financials. And let's check out the NASDAQ 100 and some of the mega caps. We have Microsoft results forthcoming here, but Microsoft up 5.3% for the month of April, but that is bested by Tesla, which is up 9%. Also mentioned Broadcom is up 15%, Apple down 4%, Amazon down 3%, and Meta down almost 5%. Also taking a look at the Dow, we're looking at some similar situation, a mix of red and green here. And on that note, I'm going to send it back to you guys for those earnings.
Thank you, Jared. Let's get to the earnings fun. Qualcomm out just now with their latest results. Let's get you those numbers. Qualcomm Q2 adjusted EPS clocks in at 285. The street was at 281. For Q3, I'm looking ahead here. Q2 revenue first, 10.84 billion versus consensus of 10.64 billion. Turning ahead, Q3 EPS, they're calling for between 260 to 280. The street was at 266. And Q3 revenue, they're calling for between 9.9 billion to 10.7 billion. The street was closer to 10.33 billion. Qualcomm, some other issues you are going to be front and center for investors. What does the CEO have to say about smartphone growth in 2025 will be key, about ASPs and margins for his chipsets, also critical. And then also, how does he weigh about tariffs? What could that impact be on his business? What's he willing to tell investors on that front?
Okay, now I've got the right release.
Now we've got the right release. Go ahead, Julie, rip it.
So, Cristiano is talking about the strong results here, and he talks about being focused on the critical factors we can control, our leading technology roadmap, best-in-class product portfolio, strong customer relationships, and operational efficiencies. So in other words, they can't control the macroeconomic environment, they can't control the tariffs, so focusing on what they can control. But investors obviously not liking the company's forecast there, because it looks like the midpoint may be a little bit short of what analysts had been anticipating. Perhaps that's what's going on here, but going to keep on digging through here. That third quarter forecast, adjusted earnings per share, 260 to 280, 266 is what was estimated. So it looks like the midpoint of that's a little bit higher. So we'll keep digging in here, see what's going on.
All right, let's move on to Microsoft, because those numbers are out as well. And we have that stock moving sharply up more than 6% here in the after hours. It looks like on the bottom line, let's start there, Q3 EPS, I see coming in at 346. I don't see a compare yet on that. On revenue, though, I see the 70.07 billion. That is a beat. The street was closer to 68.48 billion. I'm looking for Q3 Azure, other cloud revenue, XFX, up 33%. The street was at 31%, so another beat there, and that helps to explain why, at least initially here, we're seeing a strong pop. Q3 intelligent cloud revenue, $26.8 billion. Street was at $25.99 billion. Q3 Azure growth attributable to AI, 16 points. Estimate was 15.6. So a lot of beats across the board here. We don't have guidance yet. As always, Microsoft would offer that after the bell.
And in particular, guidance on CapEx is going to be interesting, as well as the financial guidance coming from the company. Productivity and business processes revenue up 10% for the company to nearly $30 billion. Intelligent cloud up by 21% to $26.8 billion. And then that more personal computing category for Microsoft up 6% to $13.4 billion. As you say, we have to wait for the call to get more. But Satya Nadella in the statement saying in the commentary here, cloud and AI are the essential inputs for every business. And Amy Hood, the CFO, talking about a strong quarter here. So not getting a lot of color commentary quite yet.
You'll get so on the call, the conference call. That's when CFO Amy Hood's going to. You'd expect her to give you that guidance,
right.
More color about cloud performance, AI spending, CapEx plans. What do they say about Trump tariffs? Because you think about Xbox, you think about tablets, and what do they see ahead?
Okay, now shall we get to Meta here? That company out also. First quarter earnings per share beating by a pretty wide margin here at $6.43 versus the $5.25 that was estimated. The company coming out with a forecast for second quarter revenue of $42.5 to $45.5 billion. Analysts have been looking for just over $44 billion in revenue. And the company says for the full year, it looks like it is changing its expense forecast. So this is not necessarily its CapEx, but I guess its CapEx is included in this. So total expenses this year, $113 to $118 billion. It had been $114 to $119. So it is bringing down its total expense forecast for the full year, but just by, not by a huge margin at this point.
Yeah, it'd be very interesting to see how they talk on the call just more about the broader online ad market and environment, because obviously the extent that you would see any kind of economic slowdown here, Julie, or maybe even a recession, I mean, what would that mean for the advertising market and for Meta in particular? CapEx, I mean, analysts didn't think we would see much of a pullback there, just given the importance we know the company is placing on AI. Tariffs and trade tensions with China, there is some concern on the street about China-based advertisers and actually whether they may pull back. But listen, right now, at least initially, that stock's popping in the after hours.
Yeah, and just to give a few other numbers here that we got, I know Dan Halley was looking for Reality Labs just to see how much money it lost, and it did lose $4.2 billion. It's a little bit smaller than the loss that analysts were anticipating. Revenue for Reality Labs coming in at $412 million. The estimate was for $496 million. Now, obviously, that's a relatively small part of Meta, but it's a part that Meta has put a lot of energy and effort into. So that's something to keep in mind. The family of apps revenue, which is the vast majority of its business, at just under $42 billion, $41.9 billion for Meta here. And I'm seeing the CapEx guide specifically here, $64 to $72 billion, which is actually an increase here. So expenses overall going down a little bit, but CapEx estimate is going higher, $64 to $72 billion. You were talking about what was going on with that. So interesting to see a little bit of an increase.
Yep.
Yeah,
not surprising. Joining us now for more earnings reaction. Let's get to Brent Till, senior analyst at Jefferies. Brent, Microsoft numbers are out. Initial response, positive, but interesting to get your reaction to the report.
Hey, Josh. Really good. I mean, Azure accelerated. It was 31 last quarter and went to mid-30s, 35% this quarter. So Microsoft had publicly guided for an acceleration, then had to pull back. They missed 2 of the last 3 quarters in Azure. So this is a good beat, pleasant surprise. Now they're 2 for 4 at the plate for making the numbers that they said. So I think everyone's still a little skeptical, but good to see the acceleration. M365, which is Office, that's 15% growth at the high end of guide, and revenue a little bit ahead, operating income ahead, EPS ahead. So far from what we can see, things are better than feared. but we don't get the guide until the call, and we'll have to hear. Remember, Amy Hood has never acknowledged there was ever a headwind, there was a blizzard, or a car stuck in a ditch because of a black ice. So they will most likely continue to give a pretty bullish update and outlook. That's Amy's pitch, and it doesn't matter how cold or hot it is, she'll hold to we are going to execute, which is their marching orders from Amy. So we think that is again probably par for the course in terms of how they're going to guide. And I think again there were a lot of concerns about Microsoft and the durability. I'd say that most of the CIOs we speak with, Microsoft's the last thing they're going to cut in a downturn. And so even if you do see things get worse, which I think everyone's anticipating things are going to get worse, we believe Microsoft will be a better place to shelter than many of the other names we cover because of their durable franchise that cuts across applications, security, infrastructure, AI, and we continue to believe in the story.
I am curious, Brent, how cold is it going to get? How slippery is the ice going to get? In other words, if Microsoft's the last expense that CIOs want to cut, how bad would it have to be to see some kind of pullback? Can Microsoft continue to execute if there is a weakening environment?
The good news for Microsoft is they have the AI story, right? Remember a couple of years back, they started this push. They were the ones that said we are moving into an AI economy, and everyone got caught flat-footed, right? Google, Amazon, everyone was chasing Microsoft's lead, and Microsoft didn't want what happened with AWS in the past cloud cycle. They were trying to catch them. So I think they have the advantage where they've been AI first. They have a good portfolio. It's infiltrated every line of business, from apps to security to infrastructure to custom development. Nadella, the CEO, was on stage with Zuckerberg yesterday and said that, they both kind of articulated that between 30 and 50% of the code in the next year is going to be written by AI. Well, Microsoft owns GitHub, which is the one of the top, if not the number one place that developers go to help write their business applications. And so, again, no one's immune. Everyone's going to get impacted. I've been impacted. Many of us have been impacted already by what's going on. So no one's going to be immune. But again, when we're talking about relative safety, the durability, the breadth of Microsoft's product line, and then their AI first mantra, and then you have the single best CFO in software running the show, and you don't want to mess with Amy. So I wouldn't want to miss a number if I was in Amy's executive team.
Yeah, you don't want to miss with Amy Hood, for sure, Brent. Very well-respected CFO. I'm curious, conference calls starting soon. If you had the chance to ask Amy a question or two, what would it be?
What's driving the Azure acceleration, and what gives you confidence in the durability as we head into stiffer economic headwinds would be one of the questions among 10 others that we have.
And Brent, I want to turn briefly to Meta here as well, because it is striking that this company is raising its CapEx spending plans for this year, as the numbers seem to also largely be ahead of estimates. What does that tell you?
It's a contrast to what Snap said, and I think it suggests, again, the larger ad platforms are going to be in a better position. They had really good numbers across the board. As you mentioned in your lead-in segment, what's interesting is they raised CapEx. Everyone thought they would cut CapEx. They actually raised CapEx from 60 to 65 billion to 64 to 72. So I think it's giving. Zuck would only do that if he sees a return. And everyone says, well, Brent, these are like railroad companies. They're spending so much money in AI. Like, how on earth are we going to see the returns? You're seeing it in 16% revenue growth, earnings numbers that were $1.20 higher, and they've done a really nice job executing. And all of our ad checks lead back to similar to what I said about if a CIO had to go to a deserted island, they would bring one vendor. They'd probably bring Microsoft. If an advertiser had to go to a deserted island, you only get one vendor to pick. You'd pick Meta because of the breadth of their offering, the quality, the return, the opportunity in wearable AI, the opportunity to improve the searchability of Instagram, you go through. There's so many different drivers in Llama. We've said this repeatedly. Llama is such a hidden secret, and I don't think I think most investors know about it. But like we think Llama is like basically a red hat inside of Meta, where you have a free call option on upside in the stock if they can figure out how to monetize Llama, which is their LLM, and everyone in open source is going to them. They're not going to just DeepSeek. It's a Llama and DeepSeek world, probably even more of a Llama than DeepSeek. But those are the two open source platforms. Closed source, you're going to obviously OpenAI and others. But they have a huge opportunity with Llama. And so I think there are multiple drivers still at Meta that are really exciting. And the fact that they're raising CapEx is, to me, a great signal that their investments already are paying off.
Yeah, and a surprise, as you said. All right, Brent, we'll let you dive back into the numbers to get ready for the calls. Thank you so much for spending some time with us.
Good to see you guys.
Coming up, who's hitting and who's missing? Stay with us. We got more earnings coming out when we return. More market domination overtime coming up. Turning now to FinTech, Robinhood is out reporting its first quarter earnings. So let's get to those numbers as well here. That company's EBITDA, adjusted EBITDA in the first quarter coming in a little light of estimates at $470 million. Analysts had been anticipating $486 million or so. Revenue here at $927 million. That is better than estimated. 921.7 is what analysts had been anticipating. Their average revenue per user at 145, which is better than estimated. And the company is boosting its share buyback authorization by $500 million. But it looks like that EBITDA miss is pushing the shares down a little bit here in the after hours.
And this is another name, too, that's had such a run, though, Julie. I mean, it was heading into the report, it was up about 30% this year. It's about 190% over the past 12 months, so just a remarkable run. It is another name, though, too, where the macro, you have questions, the extent that the economy slows or something worse. What would that mean for Robinhood? We have a very smart analyst coming up who's going to walk us through all of that.
Yes, we do.
All right, meanwhile, Qualcomm shares under pressure here following its latest earnings report. The chip giant reporting better than expected fiscal second quarter results. Adjusted earnings per share coming in at $2.85, beating the $2.81 estimate. Adjusted revenue coming in at $10.84 billion, but it's the third quarter guidance that could be weighing on the stock here. The company sees revenue coming in between $9.9 billion and $10.7 billion. Now the estimate, $10.33 billion. Well, joining us now to help us sort through all of this is Patrick Moorhead, More Insight Strategy founder, CEO, and chief analyst. Patrick, always good to see you. So we got the numbers, the initial reaction here in the after hours. Stock's under some pressure, Patrick, but walk us through the report. What do you make of the results?
Yeah, so first off, great quarter, right? They beat on the top line, they beat on the bottom line. Android handsets look really good. Automotive is still the juggernaut at a 59% growth. And then IoT, which likely will be the next major juggernaut for Qualcomm, up 27%. I think what people are responding to right now is that even though they hit the midpoint of guidance, right, the range was 9.9 to 10.7 on the forecast, analysts had 1033, which is, splitting the goalposts to, the left side slightly, but it looks to me like an overreaction, and likely, unless there's said something on the call that skews it one way or another, you can't look at this and say anything but good quarter and forecast.
Patrick, how should we think about Qualcomm's tariff exposure, especially given some of the exemptions that are in place?
Yeah, so first off, there's direct and indirect tariffs, right? Direct would be chips made overseas that are brought into the United States for final assembly, and that is very, very small. It is an infinitesimal amount. And then there is the potential for an escalation, or I would say the Trump administration saying no, smartphones that are pulled in from Vietnam, China, and other places into the United States are no longer exempt. That could possibly be something in the future. But, if you're Qualcomm, you certainly can't play a worst case card into that. But right now, they look pretty good. There has been talk about, well, what if China retaliates? The challenge with China is they need Qualcomm for their smartphones because China can't build enough smartphone processors in China that hit that high performance, high quality mark to satisfy the Chinese consumers. So even though they do sell a lot into China, China needs Qualcomm.
What do you see ahead, Patrick, for automotive and IoT, especially given in the context of these tariff worries?
Well, overall, automotive as a market looks a little shaky, but when you look at the EVs, if you look at those higher end cars with ADAS, that is a very rapidly growing market segment that Qualcomm is growing with. So automotive overall is down as a market, but Qualcomm, I believe it's just going to be going and up and to the right. And the other part is their content play, right? They started off with connectivity, and then they went to dashboard, and then they're in ADAS. So not only are they capturing a higher percentage market share of each of those, they're capturing a larger percentage of the content overall for those cars in a market that is growing. And IoT is a collection of multiple businesses. It's consumer IT, it's industrial IoT, it includes PCs and either other AI accelerators. Those are areas where Qualcomm's are relatively new markets. They're markets that most of them are growing. And Qualcomm, again, like I believe that this will turn into the next, IoT will be the next automotive business that we'll be talking about here in the next year or so.
Patrick, Cristiano Ramon's been CEO for nearly 4 years. He was named in June 2021. I'm curious, the anniversary is coming up here. You know the company, you know him. What do you make of his time so far? His strategy, where he's taking the company? Give me a grade on that.
Yeah, so if I look at the challenges that the company had ahead of it when he joined, which was companies not wanting to license or pay enough for licensing royalties, very, very top heavy with smartphones, Apple gaining market share. He came in and he executed on a diversification that is paying dividends. We're seeing it right now with automotive. We are seeing diversification and Android doing quite well, even though there's content inside of Apple that he has. He positioned the company where Apple can go to zero and the company can still grow a ton in these growth areas. And then, he's laid the groundwork for the next wave of growth, which is an IoT. So listen, I'm a hard grader, but you have to give him some variant of an A. I do know that the stock is, by any way you look at it, is a value. And I think the reality or the belief needs to, the gear needs to click in for people to see the IoT opportunity and believe that the company can execute on that.
Patrick, good to see you as always. Thank you so much.
Thank you.
Well, we have hit the 100-day mark of Trump 2.0, and we've been looking at the returns during this first 100 days in our chart of the day here. Almost everything is in the red. That's the short version of what we're talking about. But let me run through the numbers specifically. We've got WTI crude down 25%. Now, that is something that could potentially be positive, certainly for consumers. It's one of the areas of relief here is gasoline prices, even in the face of the sort of bracing for tariffs that we're seeing in the markets. But Magnificent Seven, for the people who own that in their portfolio, which is, let's face it, almost everybody, that has been painful, down 17.1%. If you look at the total return for treasuries, if you were looking for safety there, that is incorporating both yield and price, you've got a negative 10% return there. What about Bitcoin? Were you looking to hedge with Bitcoin? Nope, no luck there, down 9.6%. How about the US dollar? No, down 8.9% in that realm. And the S&P 500 itself down 7.1%. We know that the S&P has come back quite a bit from its lows earlier this month, but is still lower since Inauguration Day. The one major asset class that has risen has been gold, which is up by 20%. Now, we of course have discussed a lot what happens from here after all of these negative returns. And we were talking to Michael Kantrowitz of Piper Sandler at the top of the show, and he sees headlines continuing to dominate assets for the at least foreseeable near future, right? He says we could see a cushion to downside in stocks in particular if we do get some trade deals start to come out here. However, he's not optimistic, and most of the folks we were talking to are not terribly optimistic, even if he or folks like Mark Newton think that the lows have been put in for stocks. Now, as for gold, the sort of inverse is true. We talked to James Steele of HSBC earlier in the week. He is their senior precious metals analyst there, and he said we will continue to also see headlines kind of dominate the gold trade here. And if we do get a big relief on tariffs, that could mean a stalling out for gold prices at these levels. But this is the legacy here of the first 100 days of this administration, Josh.
Thank you, Julie. Coming up, we are taking a deeper dive into the latest earnings results from Meta and Robinhood. Stick around, much more market domination over time still to come.
Meta reporting a beat on revenue for the first quarter. The company also increasing its full-year capital expenditures outlook. Scott Devitt, Wedbush Securities Managing Director, joining us now to discuss. Scott, it's good to see you. I want to start with just the overall numbers here and the forecast for second quarter revenue of as much as $45.5 billion. We just heard from Meta's much smaller cousin Snap about this time yesterday, and it seemed like they were having some ad sales difficulties and foreseeing potentially more. Are we seeing any evidence of that of Meta? It doesn't seem to be showing up in these numbers.
Well, I think Snap has a scale issue in terms of its ad platform, so it's a totally different conversation. But at the aggregate level, the advertising industry is holding up quite well. As you mentioned, Meta beat top line, beat profitability by even more. I think relative to consensus, it was a 14% beat in profitability. It bracketed the consensus for 2Q, despite fears that Chinese e-commerce companies like Temu are potentially going to spend less on the platform because of the removal of the de minimis exemption that's pending. Meta doesn't seem concerned about that. And then, as you mentioned, CapEx going up, which shows confidence in the business for the full year. And I would also note that the company lowered its OpEx guide for the full year by $1 million as well. So another moderate positive on a net basis. So this is an extremely positive report, especially in the face of that kind of glowing concern of the China e-commerce pushback. The final point that I'll make is that, it's interesting because last quarter when companies reported, the dollar had just completed a period where it strengthened by 4 percentage points. And this quarter into the guides, the dollar had depreciated. So it's a nice offset to this uncertainty of tariffs to be able to guide into that kind of favorable light, especially with Meta having 60% of the revenue coming from outside the US.
Scott, I'm curious, separately, this very high-profile fight the company finds itself in with the FTC in Washington. I'd imagine, your clients must be asking you about that, Scott. What are you telling them?
Well, so Meta has an issue, Alphabet has an issue, everybody has an issue. That's a large company these days with the government. But I continue to believe that the backdrop with this administration is more favorable than the prior administration. It hasn't quite played out yet, but I think as these issues come to resolution, that we're going to find that the administration itself has a preferential view of U.S. technology companies, and also, nobody in government really wants to disadvantage these U.S. mega caps relative to their Chinese peers. So I'm anticipating an outcome that is essentially a slap on the wrist type of outcome and not something that meaningfully impacts the trajectory of Meta. And that goes for the other players as well.
One of the surprises we've been talking about in the Meta numbers as well is the idea that it raised its CapEx forecast for the full year to $64 to $72 billion. That, again, was a bit of a surprise here. What do you think is driving that, and what do you think gives Meta the comfort to be able to do that?
So there's two topics here. One is, as you described it, the comfort. So that means the company has confidence in the strength of the business and is comfortable continuing to spend. So that's a positive. The other thing is that investors are distinguishing between companies that are spending CapEx from an offensive standpoint versus defensive standpoint, because some look at what Alphabet's doing and think that's more defensive to keep up with the risks related to AI and its search business. And investors tend to look at Meta's increases in CapEx as being favorable because they're well positioned in terms of AI. I don't know that that's the right answer or not, but that's the way investors tend to look at it. And so this raise from a CapEx standpoint, it comforts investors in both of those areas in terms of the aggressiveness of the management team to be front-footed spending, and also in terms of the comfort that they can attain their revenue expectations for 2025.
Scott, some of your colleagues on the street, I know, they're very excited, Scott, about Llama. This is Meta's open source large language model. I'm curious whether you share in that excitement.
Maybe a little less enthused than some others. You know, there's a lot of models out there, and I've heard more favorable feedback from some of the competitor platforms, but we'll have to. It's early days, and open source particularly is super early. So I think Meta will be well positioned, whether its LLM leads or its LLM is used to add intelligence to its own platform. Either way, I think the company can win. But Llama itself, I think there's a few others that have an early advantage.
What do you think about the decision of the company to sort of offer it as a separate app? Do you think that's going to be, because now people use it, but it's not like they're opting in, right? It's just sort of built into the product. So now that it does, I guess they're doing both. It's not or, but do you think there will be that significant sort of opting in and usage of that separate app?
I think that companies like Meta and like Alphabet that have massive global scale, effectively every internet user uses the product already, is benefited by bundling services into the core. And so I would anticipate whether there is an individual separate offering over time that stands on its own, the vast majority of usage and success or failure of it is going to be based on how it's integrated into the core platform. And that's unique for their business relative to the startups that have nothing to leverage, but are gaining traction because the products are so good. But it's just the way, strategically that it makes the most sense for a company like Meta.
Scott, good to see you. Thanks so much.
Thank you.
Stick around. We got more market domination overtime still to come. Robinhood shares are under pressure. A key earnings metric, adjusted EBITDA, missed analyst expectations. Joining us now, Devin Ryan, Citizens Director of Financial Technology Research. Devin, thanks for being here. I want to zero in on that EBITDA number and what looks like a miss here. What do you make of it? Because the other numbers look relatively strong.
Hey, Julie. I wouldn't really call this a miss. I mean, this was an inline quarter, but the thing is, we get monthly metrics from Robinhood, so it's hard for there to be too much of a surprise in either direction. So results are effectively in line, but the reality is there's so much good here, I think, beneath the surface. So they grew revenues by 50%. They grew net income by 100% year over year. The EBITDA margins were over 50%. So they're incredibly profitable even as they're growing here. And then, one of the key metrics I look at is the net deposits. That's essentially their net new assets. And they had $18 billion in the quarter, which is up 60% over last year. So, I can go on and on, but just a lot of really kind of powerful growth metrics. And what's exciting is, a lot of the opportunity, I think, is still on the come here in terms of where growth is going. So they're executing right now. They closed an acquisition, trade PMR in the quarter, and they also bought back a lot of stock and they increased their authorization. So I think a little bit of noise here after the close, but I think people should be pretty happy with what the company just delivered.
Devin, I'm curious, we may be dipping a bit here in the after hours, but this stock has had just a tremendous run, Devin. I'm curious how you think about valuation for this name.
Yeah, so Josh, I remember coming on and you're talking about, can Robinhood be profitable? And I think that was a question. And then they got to profitability and how profitable can they be? The company's operating at 50% EBITDA margins right now. It's trading at north of 10 times our 2026 EBITDA estimate. So for a business growing 50%, year over year in revenues, this shouldn't be trading at south of 10 times in our estimate. So, the way I look at it, Robinhood's talking about 10xing the company over the next 10 years, and that sounds like a bold ambition, but if they can do that, we think the stock could be up, in the ballpark of that much. So you think about how well it's already done. We still think the best is yet to come, and they're just getting into these areas like credit cards, digital banking. They just again closed a deal, Trade PMR, which is a full service advice offering, custody offering, and they're getting into digital advice as well. So they're kind of checking all those boxes, and a lot of these are still very early days.
Devin, I'm curious about all these efforts, right? Robinhood, sort of reputationally, a platform that is beloved by retail traders. It has this sort of, I don't know, a little bit of a rebel kind of vibe to it, right? That I think kind of as it came up during the pandemic era, as it expands out its offerings and starts to look more and more like a traditional brokerage or even a traditional bank, do you think it can retain that sort of vibe or brand identity that keeps its customers around?
Yeah, Julie, it's a great question, and I think the key point here is they're not going to look like the incumbents. They're doing things very differently, even as they're going into some of these quote unquote more mature industries that have massive addressable markets, and that's kind of the point. Credit cards, they're giving a 3% rate with a number of features that are really differentiated, and just the user experience is very similar to what people are used to on the trading side, and they're doing that in all the other capabilities. They're increasingly leveraging artificial intelligence. They're going to be one of the leaders there. They're having an event in June around crypto, which is, in my opinion, they're going to launch a lot of new products at that event, and they're going to get into stable coins in a bigger way, and probably another number of tokenization of real world assets. Robinhood will be a big player in. So I think things will look different and feel different because they have Robinhood behind them and the way the firm is moving, but they're still going to be in these kind of traditional financial products, if you will.
Devin, I'm curious, you saw that GDP report we got this morning. To the extent that the economy slows, Devin, maybe even tips into recession, that could mean what for a name like Robinhood?
Yeah, it's a great question too, Josh. I mean, I think it's kind of good in the near term because people are actively trading, right? But to the extent we really had a full kind of batten down the hatches recession, I think that could create some very kind of near-term challenges just because that tends to coincide with more risk-off behavior, and some other metrics can be negatively impacted. So if that were to happen, I think that could be a little bit of a negative near term, but that doesn't take away from, again, the big picture here is what they're building and how they're executing. And the fact they have over 26 million customers today, every incremental product they go into, they can do it at very attractive unit economics. So that's kind of the powerful flywheel I think people are starting to realize, but you're seeing it in the $18 billion of deposits, the 60% deposit growth, the 50% revenue growth. And I think that's kind of the forest through the trees.
Devin, always great to see you. Always great to have you on the show. Thank you, my friend.
Yeah, thanks so much. Great seeing you.
Stick around. Much more market domination over time. That is still to come. Meta and Microsoft capping an eventful day of earnings. And here with the takeaways is Yahoo Finance tech editor Dan Howley. Dan.
That's right. Let's start things off with Meta. They kind of had the more interesting of the two stories. They beat on both the top and bottom line, but more importantly, they offered better guidance than initially anticipated. They say that Q2 revenue will come in between $42.5 billion and $45.5 billion. The street was looking for $44 billion. And so this kind of assuages some of the concerns for now that there's any kind of advertising slowdown coming as a result of the tariff uncertainty and broader economic uncertainty. Again, they beat for the quarter. They had EPS of $6.43. Expectations were for $5.25, and revenue came in at $42.3 billion versus $41.3 billion anticipated. And I just want to point out they also raised their full year CapEx estimates. They went from $60 billion, between $60 and $65 billion, to $64 billion to $72 billion. So a big jump there, and that's obviously related to all of the AI spending that they're going into. By the by, Meta Reality Labs segment had an operating loss of $4.21 billion for the quarter. So obviously not doing the best there. But let's switch over to Microsoft. They also beat on the top and bottom line. They saw cloud revenue of $42.4 billion. That was up 20%. One of the important things to point out here is that AI contributed 16 points of growth to Azure revenue. Now, Wall Street was expecting 15.6 points, and basically Microsoft was saying that that's a result of getting more capacity online. They've been repeatedly saying that their capacity constraint, it's causing headwinds. It's why their AI isn't as growing as fast as they would like, but now they're starting to get that online, and they're starting to be able to meet the demand that's already there that they hadn't been able to meet before. One of the other things I want to just quickly point out is on the personal computing side, and that's the PC business. They saw revenue of $13.4 billion. Wall Street thought it would come in at $12.6 billion, and part of the reason is that Windows OEM partners, they brought in more sales into the current quarter, just as kind of building up the inventory, because they said that inventory already was elevated and it remains so. So it's an idea of that pull forward of PC sales or PC shipments, just trying to get ahead of any kind of tariff uncertainty in the prior quarter.
We earlier talked to Brent Thill of Jefferies, and he said something that kind of stuck with me, which he said, these are two desert island companies. In other words, if you're a chief information officer at a company or if you're an advertiser, the last thing that you will cut is your check you write to Microsoft, or the money you send to Microsoft every month, and if you're an advertiser, what you spend on Meta. So that even if you do get sort of economic deterioration because of the tariffs or for whatever other reason, maybe they'll cut spending, these companies, eventually, but that it would be sort of a last stand or last straw or last resort that they would take.
Yeah, I mean, look, Microsoft, you obviously need to be in the cloud to play with anything when it comes to the enterprise now. And then when it comes to advertising, yeah, it's Meta, Facebook, whatever you want to call it, and Google. And, we did see declines, obviously, during COVID, but that was super extreme time. So that's all back now. And yeah, I mean, it does appear that they're weathering whatever kind of storm is coming or isn't coming or, nothing.
And then tomorrow, Amazon and Apple. We can do it all again.
Yeah, and then I'll just take a nap for a month.
Yeah, thank you, Dan. Appreciate it. Time now for what to watch Thursday, May 1st. Big tech earnings in focus tomorrow. Apple and Amazon both reporting after the markets close. Amazon announcing first quarter earnings. Analysts are keeping a close eye on the company's AWS cloud segment in Q1, as well as any commentary on forward-looking guidance.
Taking a look at Apple, it is announcing results for the second quarter. It's been a challenging quarter for the company as it faces headwinds from tariffs and mounting competition from China. Although Apple is receiving some tariff relief from President Trump, analysts are still expecting Apple's supply chain to dominate the earnings call. And tune in tomorrow for Yahoo Finance's special coverage of Apple earnings. We'll be covering all things Apple, including the earnings call, and that coverage will begin at 4:25 p.m. Eastern.
And sticking with earnings, some other big names and reports coming in tomorrow. That would be Eli Lilly, MasterCard, McDonald's. Eli Lilly announcing first quarter earnings in the morning. Company's obesity drug pipeline will be in focus. Investors will listen closely for any commentary on that as competition mounts from rival Pfizer.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
And once again, be sure to tune in tomorrow at 4:25 p.m. Eastern to catch our special coverage of Apple's latest earnings report as we break down the numbers and get you instant analyst reaction. And then at 5 p.m., we're bringing you live inside Apple's earnings call. You won't want to miss that either. Have a great night.